entries from last time. And start and hopefully finish the fund accounting ones. And basically what the way I'm doing 16 and 17, I've done this a lot of ways. I'm not sure which one is the best, but oops. So we have two methods. And the first thing I'm covering are the journal entries. And part of my reason for doing that is that to get you familiar with the journal entries of the different accounts. So that when clicking in crazy stuff here. My desk slides in and hits the right click button. And then second, we're going to go into the financial statements for each one. And then third, the recording, which includes the financial statements, obviously. So for the two different methods, the governmental wide and the fund accounting, we're going to do the journal entries for both of them, then we'll do the financial statements for both of them, then we'll go a little bit into the reporting. So that's kind of the scheme of this thing. Okay, I think okay, so we're on number 7. Okay, so property taxes are those taxes that are levied. Once they're levied, they're immediately counted as revenue. There is no earning of revenue in governmental accounting. They don't earn it. But there are other revenues that they get, and those other revenues are not something that is levied. You don't know, for instance, you don't know how many parking tickets you're going to give out. You don't know how many building permits you're going to, give out and all that kind of stuff. So those are things that you pretty much have to record as they occur. So it isn't that everything is all up front. Now, the property tax are usually the majority of it, and there's a reason why that we'll talk about later. But the other stuff is usually kind of wait until you get it, and that's kind of where we're at with the number 7. So different fine cash fees were collected. Okay, I would probably put these in separately. And so these are cash receipts. So cash asset going up. This building has a D in it, just in case you're wondering. All right, and I'll tell you why we separate those a lot of times, why it's a good idea to separate them anyways. And then row here. Some of the revenues can only be used for certain purposes. For instance, a lot of times parking tickets can only be used for police departments. So you keep them separate so that they know how much is going to the police department. Because some revenues are what they call special revenues, and that they can only be used for a certain purpose. And a lot of times things like parking tickets are part of that. Okay. Miscellaneous fees, general fund, so cash. Oops. And revenues are always going to be credits. Except when we get into the fund accounting. Every other place on the planet there, credits. I'm just gonna put on miscellaneous. Yes, asset going up. Revenues are also going up for tickets and fines. And again, these are things that you know, as you go, you record them. By the way, for the journal entry, you could combine all the cash if you wanted. And the only, excuse me, the only warning I would, so sorry. The only warning I would give you is that when you actually start doing accounting, you know, when you start doing the books, it's a good idea to try, excuse me, to try to keep the cash separate so that you can trace it. You know, if you lump them all together, someone will say, well, where's this 56? You know, we had 56,000 of things, but where is that? Where I'm looking at the cash, I can't see it. If you combine it, a lot of times you can't. And then you just make it easier on yourself. Invariably, someone's going to come up and start asking you questions about, you know, why can't I see this in the cash? And if you keep them separate, it just, you know, it makes it a lot easier. And yes, I'm telling you from experience. All right. Purchases. All right, September 3rd, we placed a purchase order for 2 pickup trucks. So these are the purchase orders we had for the 2 pickup trucks. And a purchase order is a formal offer to buy goods from a vendor. Now, when we put this purchase order in on September 3rd, do we owe the truck dealership anything at that point in time? So we made a purchase order, we gave it to them. At that point in time, do we owe them anything? No.
No.
Yeah, they may not ever bring the trucks to us. So until they act upon it, there is no legal obligation for us to do anything. A transaction has not happened. Okay, so the purchase order does not trigger transaction. So here would be no entry. And it's because there is no transaction. I'm gonna put it down. Oops. All right, no entry, no transactions. So we don't do anything with that. Because again, this might not, you know, we might not ever see these. All right, on October 8th, the pickup truck is received at a total cost of $53,701. And it was paid on November 1st. So apparently when they picked it up, they didn't pay for it. Okay, so we get this pickup truck. So what's the journal entry for that going to be?
Is it debit asset and credit AP?
Yes, yes. Yeah, so we'll have a asset, probably something like equipment or something along those lines. Oops. You could also just put in truck if you need this one. So this will be an asset going up. And we have accounts payable. You know, I'm gonna change it to vouchers payable. It's the same thing, but in the book they'll show vouchers payable. And then I'll talk a little bit about what a voucher is. Companies use these vouchers too. So it's equipment is an asset going up, and then for our balance sheet to balance, we have a liability going up. It's for 53,701. Okay, vouchers payable. Vouchers payable is the same thing as an accounts payable. And by the way, on the test, it doesn't matter to me which one you put in. But vouchers payable is what you're seeing in the book, and vouchers payable is a lot of time what they'll talk about for governmental accounting. It's used for other types of accounting too. And I'll do it down here. Whoa. Weird formatting. Okay. So it's sort of like this. When you have an accounts payable, before you pay the accounts payable, there are three things you match up. Lost my cursor. Here we go. So for accounts payable, there are three things that you match up. You match up the purchase order. You match up the receiving report. And you match up the vendor invoice. So accounts payable, before you pay it, you're going to match up, oops. You're going to match up those three things. Before you pay it. You do the same thing for vouchers payable. But generally what you do is once you get these three things, it kind of goes in the opposite direction. Once you get those three things in, then you create a vouchers payable. So vouchers payable comes on after you get these three things in generally. It's the exact same thing. It's just that vouchers payable then goes into the system. And a vouchers payable is automatically paid. Accounts payables are not automatically paid because you're waiting for the three documents. You know, purchase order, make sure you ordered it. Receiving report, make sure you received it. And then a vendor invoice, making sure that, you know, of what you agreed upon or close to it in this case, you know, is put in for approval. So an accounts payable is just sitting there a lot of times waiting for these three things to come in. Vouchers payable don't go on the books until you have those three things. And the vouchers payable is always paid. So vouchers payable, once it gets on the books, it will be paid. And so a lot of times, and companies use vouchers payable too. It's not just for government agencies. A lot of times companies will have vouchers payable. And sometimes, you know, there's always some, there's always, you know, it's not always it's so straightforward. Sometimes a purchase order, there'll be things that won't be on there, and the receiving report will have different things. And basically, you're really looking for this receiving report to match up with the invoice. This is probably the most important one to do, because a lot of times, you know, something will be back ordered or something like that. But they're basically the same thing. But the book will show vouchers. Okay. Enough talking. All right, and the November 1st, I guess. We pay it. So how are we gonna pay off the vouchers payable?
Debit voucher payables, credit cash.
Yep. So voucher payable, this will be a liability. Going down, we're paying it now, we don't owe them anymore. And our cash is going down. Okay, so again, it's not just payable, it's changed. It's virtually the same thing as your accounts payable. It's just that once it's on the books, it will automatically be paid because it shows that these three documents have all been matched up. First one, did we actually order it? And then these two, did what we receive, does that show up on the vendor's invoice? And if it doesn't, if it's not the same, then we don't pay it. It doesn't get a voucher. Okay. Same thing here. Ordering here, desks. Oh, I did chair. And see, here's the thing between the there won't be anything on the receiving report for this desk large gray back ordered, so the vendor invoice should match up or come close to matching up to this. I'm sorry, this up here. Yeah. Okay. And again, no entry for the purchase order. Okay, this is it'd probably be like office equipment. You can actually put in what they are too. There's nothing wrong with it. I've been at places where they've been very specific as far as what they are. I've been places that just kind of put it into a pool. But so I'm gonna say office equipment. Well, you know what, actually, a lot of times what they will do is give they'll put tag numbers on them. So this is what it would look like in real life. They would do what they call it, put a tag on it. I'm making these tags up, by the way. So this tag will be 298. Okay. I'm just making this up. Oops. Yeah, this one will be 299. And this one will be tagged 300. So I'll show you how they actually do it at accounting. And they'll have these asset tags or asset numbers will be put on. And as an accounting person, you'll maybe be tasked with doing that. Oops. So when the stuff comes in, you put it on the books. So office equipment, and you might even put the description of it, but 298. And they don't tell us how much they all were. I guess I can't do it this way. Darn it. I was put all the tag numbers on. I'll show you bad accounting. How about that? If this was broken out for, for each one, it would be easier to do. I should do that. I can know what to do it next time. And vouchers payable. Okay. Scrub some numbers together a little more. So a lot of times you'll have in your books, you'll have a list of assets, and you put the numbers on those so you can go back and trace them.
Professor, I have a question. Was the total supposed to equal the total cost of those items?
Well, this is the purchase order, and these are the estimated costs of it.
Oh, estimated cost. Okay.
I think it came in a little bit lower than those.
Yeah. Okay.
And some purchase orders, sometimes they come in exactly. Hopefully they will, but sometimes they don't. Yeah, the total of that is 1,158, but for whatever reason, they came in a little bit lower. Yeah, so and if they didn't come in at these prices, you could put these in as 3 separate entries. A lot of times, though, the equipment, you put these tags on it, and they're literally like stickers. They're literally stickers, and you can print them out. Just get stickers from Office Max or whatever. If you're in a smaller place, larger places will have their own. And they just they print these things out. Sometimes if you're in a manufacturing place, it'll be metal. They'll usually have metal ones and all that. And all these assets, they'll stick it on there. And so when they come in and look for that, to say, okay, well, what pieces of equipment do we have on the floor? Like when they just do an audit, they'll go and they'll trace from the book. They'll go from here. And they'll say, okay, where is asset 298? And they'll go looking around for asset 298. Where hopefully there'll be a better description than what I put in here, but and verify it going from the book. And then what they'll also do, they go from the book, what they call going book to floor, but they'll also go on the floor and they'll go look for something. They'll say, okay, here's, pick it up. Okay, here's this chair is number whatever. This chair is number 298 or whatever it is. And then they'll go and look in the books and make sure that chair is actually on the books. So they do book to floor auditing, and then they do floor to book. And they look by those tag numbers, basically, and that should have the cost of it and the depreciation and all that kind of stuff. Okay. And the easy one is paying it off. The easy, but the most painful one is paying it off.
Vouchers payable and then cash.
Yep. So the vouchers payable is going down. That's not how you spell payable, just in case you're wondering. So that is a liability. It's going down. And our cash is also going down. And again, so they generally use vouchers payable in governmental accounting, but they actually use it also in regular for-profit accounting too. So it's not unusual at all to have companies that have vouchers payable instead of accounts payable. I can tell you another step that comes out of this though for auditing. one of the, if you think about it, whenever there's a receiving report, that means they must have sent whatever it is. Right? I mean, if we received it and it matches up to a purchase order, for example, that must have meant that we have an obligation at that point. Right? We ordered it, they sent it. And if we're waiting for the invoice to come in before we put the payable on the books, or before we pay it, one thing you do as an auditor is you go around and look for receiving reports that aren't matched up to invoices. Because especially if they're using a voucher system, that might not go in as a voucher at all, a lot of times until it's matched up with that invoice. So, there is this idea that once you receive it, it is considered a liability. So as an auditor, you go through those receiving reports that aren't matched up to an invoice and ready for payment, just to see if there's any additional liabilities that you put on the books. And those should also be picked up as inventory or some kind of an asset, right? I mean, if they have it in their possession, they owe somebody and it should be picked up as an asset. Okay, liabilities to other funds. This is a little bit wacky. And it's extra room here. We usually do have extra. I'll put it up here for. Okay. It's sort of like this. Liabilities to outside vendors are kind of what we just did. And these will be vouchers payable. Possibly accounts payable. Depending on how they do their stuff. Liabilities to other, and by the way, this is what we just did up here. Right, this is the vouchers payable. I think this was. Liabilities to outside vendors, scratch that, to other funds. In other funds are referred to as due tos. So it'll be due to state. Due to whatever, due to the whatever investment fund or whatever it is. But due to is when you owe somebody. Now, if they owe you, it's a due from, and this is between funds. So that due to state, due to federal, due to investment, whatever. And basically it's because there's different rules for inter-fund kind of obligations as opposed to accounts payable. Accounts payable and purchases, those are all pretty much done by what they call contract law. And it's so common that a lot of times you don't even think about it. But like contract law is, well, I'll tell you, you go to the grocery store and you buy milk. There's actually gonna be a sales contract for that. Because what you're gonna do is you're gonna bring the milk up to the checker and you put it on a belt, and let's say it said it was $3 in the store. You're offering to buy it for $3. Now, if they ring it up and it rings up $3.20, you say, wait a minute, that was a $3. They say, well, it's, whatever, who knows? Then you get a big fist fight. No. But if so if they ring the milk up and it's different, what they're doing is rejecting your offer of $3. And then they're offering it to you at $3.20. Now you're under no obligation to take it. You can say, no, I'm not gonna pay $3.20 for it and walk out. But when you put something on the checker belt, the cashier belt, that is you offering to buy it for whatever you saw it listed for in the store. So that's it's all contract law. And that's the same thing that happens with between external groups and with the whatever the municipality is, a state or federal government or whatever it is. So those are government contracts. Now those obligations are different when they're between government agencies. It's not the same set of rules. One is a private transaction, one's a governmental transaction. So they're kind of they're kind of two different things. And to separate those, they don't use payables, they use due to. And they also don't use receivables, they use due from. So if the state owes us, we'll have a due from the state. Okay, so let's see how this works out. Common one is payroll. City pays $70,000 to employees. The city collects state withholding tax and federal withholding tax for the employees' paychecks during the month of April. The state sales tax withheld were $3,000 and federal taxes were $1,600. These amounts are taken out of the employees' paychecks. Okay. The withheld taxes will not be paid to state federal governments until June 15th. But the rest of the payroll will be okay. Okay, so we're going to withhold by law. This is for the state, withheld $3,000. Federal. Okay. Okay, so we are going to have something like salaries expense, I would assume. And expenses are always debits. Except for the next, except for fund accounting, we'll find out. So salaries expense are, revenues are virtually always credits and expenses are always debits. Okay, so salaries expense be 70,000. Now we withheld some from their paychecks. State, so this will be due to state. Due to federal. And the rest of it will be paid to the employees. So we make out their check, that'll be their net pay. $19,000.
$51,000.
$51,000. Thank you. So when they get their paychecks, this is what they're going to be looking at, in total, obviously. And then down here, we will remit those payments to, and it's just like a payable. Let me put this in. This is a liability going up. We owe the state. Okay, and so when we pay them off, just gonna reverse them out, just like we did, so this is just like a payable. So we pay the state, we'll say. Due to state, we're now paying it, so the liability is going down. And we'll send them a check for 3,000. Oh, wrong one. Asset going down. 3,000. And same thing for the state. No, federal, I'm sorry. So we have these due tos instead of payables. And again, it's a little bit wacky, but it's not so crazy. And it's basically because there's kind of different rules to it, but they behave just like any other liability. You pay them off just like paying off accounts payable or vouchers payable. They're exactly the same. Okay. Park District collected $50,000 cash from the sales, from sales that are subject to state sales tax. On top of the March sales, another $5,000 in cash. State sales taxes were collected. You're gonna crack up at this. My wife is a she used to be a English professor. So he cringes sometimes when he sees her. Anyway, sales taxes will not be paid to the state until April 20th. Okay, so they collected, so they had these sales of $50,000. They got $50,000 cash in, and another $5,000 for state sales taxes on top of it. So what's the journal entry going to be for that? What accounts are we going to use? What's one of the accounts? Oh, come on, you guys. You're toying with me.
All right, cash should be credited.
Well, when they pay it, well, I'm sorry, when they first make the sale, the March sales. So when they first make the March sales, your cash is going to go up. And it depends on whether we want to include both of them together or not, but I'm going to include them separate. I'm going to do them separate. So the sales were 50,000, and we're just going to pick that up as revenue. Doesn't say what they were. I'll say revenue Park District. Yeah, because that may also be a special revenue. And then they also charged sales tax of 5,000. So we collected it. Now, we don't count that as revenue. What are we gonna put that in the books as? Who do we have to give that to?
We have to acknowledge as a liability on the books.
Right, so we're gonna have it, this is probably due to state. You know, the liability due to state, and again, that's similar, it's similar to a payable, it's just this to another government agency. So that's a liability. Going up, we now owe the state 5,000. Oh, I didn't put the number in. Just need the number in these ACCT journal entries. Did I ever show you guys the history of journal entries, how they kind of came about? It's actually, well, for me, anyways, it's fascinating for me, maybe not anyone else, but you know, because you wonder why they're called journal entries. They used to write them out as journals, and then someone came up with this shorthand, you know, of how to write down a transaction rather than writing out, you know, 3 paragraphs of a journal. Okay, so we have we collected the cash. Now the state's gonna want that, and we pay it on the 20th. So on the 20th, we'll do what?
Debit sales tax payable, credit cash.
Yeah, so if you want to put what it is, but remember to, they use this due to thing.
Oh, yeah, so due to states, yep, sorry.
Yeah, no, but it would, but for what it is, you may want to put due to state, you know, there's nothing wrong with this. Because there might be a whole bunch of things that are owed back and forth, you know, to. You know, that it would not be a bad idea. So this would be a liability. Down. 5,000. And yeah, we pay cash to them. And again, these are just like payables, you know, they're just like yeah, the ledger pads. I'll tell you something funny, you know, when back in the day when I took the CPA exam, you know, they give you they used to give it in 2 different forms. It was all handwritten. Actually, it was so handwritten you couldn't use a calculator. Calculator would know. You had to do it all by hand. But they would give you the test itself, and then they give you the answer sheets. And I remember that they give us the answer sheets would be these ledgers, so these little tiny little lines, and they'd be huge, and these huge long pages, these tiny little lines. I remember it was like the hardest part about it was like, what is this? You know, because I had never seen them before. It was like, oh, okay. And then start trying to figure out, okay, I guess you just put numbers in here, and okay, I get it. But yeah, they have the written ledger sheets on them. And I'll tell you something also was funny back then. The CPA exam, you would take it. So they had the exam and then your answer sheet. Excuse me, you turn in your answer sheet. So when you finish the day, you turn in your answer sheet, and you'd give them an envelope, and they would take your exam and put it in the envelope. They would send you the exact exam you took and whatever you wrote on and all that stuff. It was what they called an open exam. Everyone knew what the questions of the CPA exam were from the previous years, because you just have them sent back. And I remember, you know, I got mine back in the mail, and by that time I was sure I'd failed. I didn't even look at them, but I did pass it. But you know, for the next, it usually take like 3 months to get to know. The longest 3 months of my life, but yeah, I ended up passing it. But yeah, they send the exact exam is sent back to you. What if I still have it? I get so mad I threw it away.
Professor, I have a question.
Yeah.
So would be the part you would start with the CPA exam nowadays?
When you start studying?
Yeah, which part?
Which part? Well, next year they're going to a completely different format. But I would almost encourage you to wait till next year because I think that they're giving 3 years under the old format, which is still going on this year. But yeah, the hardest one that they always had was financial accounting and reporting. That's always the biggest one. When I took the exam, there used to be 5 parts. There was 2 parts for practice, and then there was also a theory part that was almost the same type of thing, but you got more into the why do you do this kind of stuff. So there's really like 3 parts that used to be the one that we have for financial accounting and reporting. So financial reporting there's a lot in it.
Yeah.
Yeah, so that's probably the hardest one. But as far as studying for it, there's another weird thing about the exam. I think I'll do it and I keep forgetting. There are ways to study for the CPA exam. You can't study ahead of time. It's really jammed into probably 6 to 8 weeks. If you start getting out further than that, you just start forgetting stuff.
Okay.
So, some people say, well, I'm gonna start studying a year ahead of time. You're wasting your time. You knowing how your brain works, your brain is programmed to forget. It has to. When a car goes down the street and it's a blue car, you see it, it's a blue car, your brain immediately says, who cares? And you forget it within, a millionth of a second. You don't even know you're forgetting it. You don't even know you ever even recognized it. Your brain is programmed to forget. So, you got to kind of overcome that when you take the CPA exam. And there are actually kind of sort of tricks to do it. But anyway, it's a very short period of time. You jam in a lot. And that's when you to take the exams, that's what you do. And again, it cannot be done way ahead of time. There is no, we'll do a couple problems a week kind of thing. It doesn't work that way. Your brain doesn't work that way.
So Professor, what's the advantage of the new format you mentioned for next year?
Yeah, the new format, I'll send it out. It actually allows you to specialize in, basically it's like auditing, taxes, and then business, which is kind of like consulting. And those are the 3 main parts of CPA practice. They do consulting, they do audits, and they do taxes. The CPA license is only for doing audits. Anyone can do taxes, anyone can do consulting. I mean, they can't do it as well, obviously, but you know what I mean? Yeah, anyone can do that. Whereas taxes are only for CPAs, and that's when you pass the CPA exam. Even though they have 3 different specializations, it does not change the CPA exam license. It's exactly the same.
Oh, I see.
So, and it doesn't make you a specialist either. Now, I would say though, that if you're going into taxes and you pass the tax part, I would think they'd have to count for something. But technically, the license is exactly the same, and it doesn't have any specializations on it. For each state will go out the same license they've always given out.
Sounds good. Thank you so much.
Yeah, I'll put up something. Other people have asked for classes. I'll do that. Kind of put it out. But yeah, that change is coming next year.
Sounds good. Thank you.
Yeah, I kind of feel bad about it though, because there are people. A lot of times it takes more than one go around to pass all the parts, and so I feel bad that there's people who maybe partway into the current one, and maybe they would have passed it on it, but they're going to be forced within like 3 years. I guess 3 years is enough time, to pass it or not. Okay, we'll do this and then we'll take a break. Last of this is an easy one. This is just a notes payable transaction like you did in first accounting class. Because of lag in collection of property taxes, a tax anticipation note was obtained on July 1st for $500,000. Note carries 3% interest. These notes are usually they're usually very low interest rates because they're backed by the taxes that are levied. And a lot of times they're not, not for 100% of the taxes, but for a smaller percentage of them. So they're usually fairly low. 3% may even be high, maybe not today, but. Okay, so we get the note payable. What's gonna be the journal entry for it? So we go to the bank, we get a tax anticipation note. So we sign the note. Yeah,
We gonna receive the cash, right?
cash and asset going up. 100,000. And. Yeah, but it'd be notes payable, tax, whatever you wanna put there. You have to put this in. And this is a liability going up. And this is just because there could be a lag of the taxes coming in, and a lot of times these are fairly reasonable because they're very low risk. And they're backed by the property taxes, so. There's very little risk that these are not gonna be paid off. And if the property tax levy might be $2 million and they're asking for 500,000, so. It'd be easily. A very low risk. All right, now. When we pay it off. We're gonna pay off the note payable. We're gonna spell it correctly. So this would be a liability. What am I doing? Going down. For 500,000. But we also. Owe them. Interest. And I'm just gonna do this by the month. Sometimes they go by days, but I'm just gonna do it by the month. Okay, so we're gonna have some interest expense here. And let's see, this would be 500,000. It's 3% times. See, July, well, it's 4 months, right? 7 to 11. July, August, September, October, November, yeah, so it's 4. So let's say 4 over 12.
Is it 5,000?
Yeah, I think so, that's what I can do. Did it look wrong? No, that's right. Because 3% would be 15,000 for the entire year, 4 for 12 is 1/3, yeah, that's. Okay. And so then we write out a check for cash. So we got some of those, collected some of the taxes, so 505,000. And again, this is a very, tax anticipation notes are very common, and if for no other reason, then usually the interest rate charged on them is very low. They're very easy to get, very low, and you don't have to worry about running out of cash to pay for something. Okay, so let's say, let's be back, we're gonna start the other one, come back, so let's say be back at. $657, no, it's 707. Yeah. Okay, fund accounting handout, and you'll notice it looks exactly the same as what we just did. And I'm going to talk a little bit about what fund accounting is sort of about, because this one's going to be wacky. Oops. Second. Fund accounting is like a checkbook with a budget. And the checkbook is for 1 year and the budget is for 1 year. Now, when you think about your checkbook, really the only thing in your checkbook is cash, right? I mean, that's the only asset that's really in your checkbook. It's the same thing here. It's basically gonna be for cash. How much cash do you have? How much cash can you spend? You have this budget. How do you manage that budget in your checkbook? That's basically what it is. So it's sort of like a checkbook where, here's the checks we wrote, but there's also budget accounts. The budget accounts, it's a legal budget, it's a legal thing. You actually put it on the books, and it would be very strange if it came out exactly right, but you try to adhere to it as well as possible to that budget. And obviously, the budget is not the actual money spent, right? I mean, it can't be. You don't have a crystal ball. You can't look at the future and know exactly how much you're going to pay for road salt. Is it going to snow a lot? Is it going to snow a little? You don't know those things. So it's a budget. It's an estimate. There are ways to come up with the estimate for that. But yeah, so that's going to be the kind of the idea behind it is, some of it is just a checkbook, and some are going to be budget. Okay. This is what you'll generally see for a budget. You'll have, I'm going to split this up into two different things. Oops, what am I doing? So this is funds coming in up here. I'll make those green. And down here, these are funds going out. So up on top, these are funds coming in. And coming down here, these are funds going out. So appropriations are estimated expenditures. So estimated revenues And estimated expenditures are similar to expenses, but we'll talk about the difference between those two. So estimated revenues and estimated expenditures, so that's what you normally have, but there's also these other things. And this is when other funds are gonna give us some of their money. Or it could be, in this case, they're gonna have a bond issue to get money, but it's where these money comes from someplace other than revenues. And down here, some of the stuff we don't pay ourselves, we pay it out to somebody else to use, so. For instance, maybe there's a separate park district nearby or something that we might transfer money out to. So we're not gonna spend the money, we're gonna get it through however we get our funds coming in, and we are going to give it to somebody else to spend. So you have these other financing sources and other financing uses that are basically money coming in that's not revenues and money going out that aren't expenditures. Someone else is going to spend it. Someone else is giving us money, or we're getting money from some other place. And again, all of these are estimated. It's a budget at the beginning of the year. What do we think we're going to spend? And we work it out. Well, you guys saw how we did it last class, right? No, how are we going to get this money? We had to come up with, I forget what it was, 3,800,000 or something like that. How are we going to come up with it? And then you budget out how you're going to do that. And again, we don't have a crystal ball. We don't know exactly what it's going to be, but you have to make an estimate at the beginning of the year, and it has to be a reasonable one. And we'll talk about what it is to be a legal budget. So anyway, these are all estimated amounts. All estimated amounts. Now, how do you put the budget on the books? Well, you're going to think I'm crazy, but it's sort of like opposite day. Now, revenues are always credits, except when you're putting a budget on the books. I'll tell why in a second here. So estimated revenues are going to go on the books as a debit. Estimated other financing sources. A debit. I'll put what it's there not. Bonds payable. And the appropriations are your estimated expenditures. They're always called appropriations, though. You'll see it called appropriations. In the U.S. Congress, the most prized committee you can be on is the Appropriations Committee, because the Appropriations Committee is what they're the ones that divvy up the money and how it gets spent. And guess what? If you're from wherever. You're from Illinois and you're on the Appropriations Committee, guess who gets a big, so the most sought after committees are the appropriations, and that's because that's where the money gets spent. Okay, so appropriations. Now appropriations are sort of like expenses, which are always debits, but we're going to credit it. Other financing uses. Okay. All right, now, these two sides. Right now, I don't think they balance.
No, they're off by $4,000.
4,000?
Yeah.
90? Yeah, okay, 186. Okay. So this is gonna go into what we call budgeted fund balance. Oops. And this is sort of like an equity account. There actually isn't an equity account, but it's sort of like a retained earnings, but it's not really. I probably shouldn't put equity in there. But no one actually has stock in Chicago, state of Illinois. But this is a plug number to make it balance. I mean, I'm gonna put that. Now, an obvious question is, why are we putting these in backwards? Why are we putting the revenues in as debits and the expenses, or more appropriately expenditures, are going in as credits? That's exactly opposite of what, this, the budget entry is sort of like a closing entry done on the first day of the year. This is sort of like a closing entry. If everything goes as planned, this will be our closing entry at the end of the year. So the budget is sort of like a closing entry done on the first day. If everything goes as planned, when we do our closing entry, it'll look like this, but without the estimated. And without the budgeted. This will be what we have for the closing entry. So normal accounting, we don't put a budget on the books. This side of accounting, we put a budget on the books and we go, okay, we put this budget on the books. We want to see what it's going to look like at the end of the year. If everything that we think is going to happen, what is the closing entry going to look like? And so that is why it looks like that. That's why the revenues are debits, because if our closing entry, when we close it out, we're going to debit the revenues to close them out to bring them back to zero to start the next year. So this is sort of like a closing entry. It's not the actual closing entry, but it's like a closing entry done on the first day of the year. Now, none of these accounts go on any financial statements because they haven't really happened. So the budget accounts do not show up on the financial statements. Only the real things that happen show up on the financial statements. So this is a budget account. No one else is gonna, well, they'll see the budget, but no one else is gonna see this journal entry, or these accounts are not gonna show up on any financial statement. They're there so that people who are writing the checks can have something to look back on and control it. Okay, let's do the next one. Go ahead and put it in and I'll come on, a little different than we expected. By the way, you sometimes see other financing sources just abbreviated. Ah. Hold on a second. Okay. So you see OFS. All right, well. So the estimated, or excuse me, the budget fund balance will be a debit. $50,000. And I'm gonna talk about that for just a second. So, and again, this is just a plug number. Now, if you notice something. Up here, the stuff coming in was more than the stuff going out. So we have a little bit left over, 4,000 left over. So you talk about, would this be a legal budget? Yeah, this is a legal budget. This we're gonna more than cover our money going out. So money coming in will more than cover the money going out. In fact, we'll have a little left over if everything goes as planned. Now coming down here, you say, well, wait a minute. We have more stuff going out than coming in. We only have 2,100,000 coming in, and we have 2,150,000 going out. This can still be a legal budget if there's at least 50,000 in the fund balance. So, the $50,000 shortfall, if there's at least 50,000 in the fund balance, so if that cushion, there's at least $50,000 in the cushion, it's a legal budget. Any question on that? So again, this is something completely different than what we were seeing in the other class, and that is we have these estimated accounts that are put on there as a journal entry. They do not show up on the financial statements, but they are required because they are what you're going to be using to guide you through the through the year. Okay, property tax revenue. This is going to be exactly the same as we did before. We can we probably don't need to do these again. This is exactly the same as government-wide accounting. Same rules and everything. You know, they recognize, you know, reduce the amount of revenue by the uncollectible. This will be deferred revenue going into the next year. Everything's exactly the same. So I'm not going to go over these. And you don't have to do those, you know, just make a note that all of this is going to be exactly the same. I put in different numbers, but. Okay. So. Basically, all of these are going to be exactly the same as we had before. So revenues are pretty much the same. Okay, and that leads us to the new wacky thing we're going to have. We need a new budget account. So let's go to number 8, if you would. Oops, what are we doing here? Okay, so this is where the budget's going to come in again. All right. Normally, purchase orders, you don't make any journal entry because nothing's happened. We just did that, right? But you make out a purchase order, and if they never send you anything, you know, no transactions happen when you first send out the purchase order. All right, now there is something going on though, and when you're doing the fund accounting and you have this budget, the legal budget you must stick to. You cannot have the same people spending the same money twice. You know, you don't want everyone looking at it and going, oh, well, there's 300,000 in the account. I'll use that for this. And someone else will say, oh, there's 300,000 in the account. I'll use that for this. Someone else will get, you know, you get the idea. So we have budgetary accounts called encumbrances that we use when they make a purchase order. So on September 3rd, when we make this purchase order, we are going to place our hand on the money with what they call an encumbrance. All right, so let's see, the total purchase orders were. What is that, 94,000? So we're going to place our hand on $94,000. What this account tells everybody is, look, don't spend this 94,000, we've already spent it. So this is done when there's a purchase order is made. It's a budget account. This does not show up on any financial statement. But it's there for budgeting so that people don't re-spend the same money over and over again. So someone looking at this will say, oh, well, let's, oh, there's all this money in there. Oh, wait a minute, there's 94,000 that's already been set aside. Okay, so on October 8th, the pickup truck comes in at a cost of $53,701. So here's what we're going to do. So the pickup truck comes in. Now we're going to put the pickup truck on the books and that liability. Now that liability, that vouchers payable or accounts payable, whichever one we use, that is going to show up and people will know, okay, I can't spend it because there is this, there's already this payable on the books for the stuff that came in. Okay, so the first thing we got to do is take our hands off the money. We're going to take our hands off the money at exactly what we put our hands on the money. So we're going to do it based on the purchase order. We're going to take our hands off the money based on the purchase order. How do you zoom? Okay, here we go. So we're basically going to reverse this out up here. So encumbrances outstanding. Now whose truck is this? Well, this is the truck. So we put our hand on 53,000 for this truck. We now have to take our hand off 53,000. And by the way, the term encumbrance is sort of like a constraint. It's the way it's turned here financially. When you say encumbrance, it means kind of like a constraint on it. For instance, if you buy a piece of property that the people didn't pay taxes on, they would say the back taxes are an encumbrance on the property. In other words, you buy the property, you got to pay the back taxes on it. So an encumbrance is sort of, kind of like a constraint on whatever it is. So, and if you think about it, that's what this is saying, look, you can't spend this money because it's already been spoken to. I mean, there's other non-financial reasons, terms for encumbrance, like carrying a heavy load or something. They were encumbered by their backpacks or whatever. But in this case, it means kind of like a constraint on whatever it is you're doing. Okay, now, so that's wacky enough. There is now a new wacky thing we're going to talk about. And that is, we do not put any long-term assets on the books using fund accounting. So we're still going to have our vouchers payable. And it'll be going up for 53, what are we on? 53,701. Everything that we spend money on in fund accounting is just called an expenditure. You might put what it is for, but it's an expenditure. So, and if you just put expenditure, that's fine. Anytime you buy anything, it's an expenditure. Anytime you spend money, it's an expenditure. It's just money going out. Once you get used to using it, you'll actually like it because you don't have to even think about what it is. You know, if you buy postage stamps, it's an expenditure. If you buy a truck, it's an expenditure. If you buy a library building, it's an expenditure. If you, pay the payroll, it's an expenditure. Everything is an expenditure. There isn't any, it doesn't matter whether you're spending money on the Empire State Building or buying, buying postage stamps. It's an expenditure. Everything is just an expenditure in fund accounting. It's like in your checkbook. I spent money, I spent money, I spent money. It's the exact same thing. You want to know what the balance is in your checkbook, right? So, it's just what did you pay for it? Doesn't get too far into what it was. They're mostly just expenditures. With very few exceptions, if you're paying off like liabilities or something like that, but whenever you spend money, it's basically going to be an expenditure. Now, when we pay off the payables, it's just going to be the same as we did before. So this voucher payable is going to be, if you think about this is exactly the same. There's a timing difference. So there's just an expenditure on the books. Now we pay off the vouchers payable. That's going to be the same. So again, there are kind of two wacky things in this going on in this. The encumbrances are putting your hand on the money. You put your hand on the money, saying, look, everybody, don't spend this. When the item comes in, you're going to take your hand off the money, but you're going to put this liability on the book so people know, oh, that's already spent also. And plus it's expenditure.
Professor, I have a question here.
Yeah,
The encumbrance outstanding accounts, does that shows on the financial statements?
nope.
Okay,
Yeah, these are budget accounts. So this is a budget account. It's not going to show on anything. They're both at budget accounts.
thank you.
Yeah. And two, there is a question, well, what happens if they never send the other truck, right? Yeah, we ordered 2 of them, but they only sent 1. Well, at the end of the year, if they haven't sent it, you have a choice of leaving it on the books, and sometimes they'll put these encumbrance on based on years, so this might be encumbrance 2023 or whatever. And sometimes you'll have an encumbrance from the previous year that's still on the books, because you might say, well, we're still waiting for them to send the second truck and they haven't sent it yet. So, so you'll get kind of some of those strange things that encumbrances can actually go for more than 1 year, depending on if they're going to keep them open or not. If they say, okay, well, we don't, you didn't send the other truck and now we don't want it, we got it somewhere else or whatever, then you can take it off the books. But those encumbrances, they're not on any financial statement. Sometimes they'll put them in the notes just as references, but they don't show up on any financial statement to answer your question. Yeah, they're budget accounts similar to the actual budget account up here. All right. Okay. Let's go ahead and we'll do this one. I think we'll call it a day. Yeah, so this one is kind of way, so anytime you buy like stuff that you have a purchase order for, when you have the purchase order, you put an encumbrance on the books. Purchase order is placed. Oh, how much is this? $2,078. You want to check that?
Yes, that's correct.
Yeah, okay, good. So that's what we're gonna put the encumbrances on. And again, these are just, these are budget accounts. They do not go on any financial statements, they're just, there to, well, they're actually there for good reason, they're there to tell everybody, don't spend this money, it's already spent. So putting our hand on the money. Don't spend this, we already spent it. All right, coming down here. Oh, well, we didn't receive everything. Gotta get a total for the first three things. Should have kept it, I already added that up. If I'd been smart, I would have, got a total in there. Okay, the 134.
1158.
Thank you. Okay, so we have to, of these encumbrances, we have to take our hands off 1158. I'm just gonna type that in so I don't forget it. And we're gonna reverse this up here. So taking our hands off the money, but now we're going to put it on the books for 1125. 1,125. All right, what's our new account that we love for putting anything that we buy on the books?
Expenditure account.
And again, you can put what it is. There's nothing wrong with putting, office equipment. But everything is just an expenditure. And we'll have vouchers payable. And by the way, someone said, well, do we have a gain or loss based on these encumbrances? No, these don't actually go on the financial statement. So there is no gain or loss on, if they come in a little bit different, whether it's a little higher, a little lower. These are not really, these are budget accounts. They didn't really happen. So there is no gain or loss on that. Now, hopefully they're close, but. Okay, and then down here, we just pay it. And you don't have to put this. Oops. Put the wrong thing in like I just did, but you don't have to put these, the liability and asset. I just do that so you know why I'm debiting or crediting. So a little bit wacky. Yeah. Question on that thing? Let's stop here. Only so much governmental accounting you can do before, you know. And I think we hit that a while ago, so. Let's stop here. Okay, I think it's in the assignments. If you wanted to put the government wide one in, we finished that. And you do not need to. You can skip. I'll put it right in here, let's say. There's nothing wrong if you want to do these, but skip 3. Three through 7. You don't need to do it. If you want to do them, I mean, I don't mind doing them. If you want to do them just for practice, I can put those solutions up next time. You don't need to do it. You guys cannot see what I'm doing. I'm sorry. So you can skip 3 through 7. And the one we're doing now, the fund accounting. But if you want to turn in the government wide one, there's a drop for it. So fund accounting, skip 3 through 7. If you want to do them, you can. I don't mind putting them up if you're curious as what they would look like. I don't mind doing them, but they're going to be exactly the same as we did for the government wide. Okay. I've had enough fun. Hopefully you guys have. See you guys next week. I think there's a test due.
So we're gonna finish the rest of this next week, Professor, the ending.
Yeah, we're not gonna finish this
Sure.
one. Yeah, we'll finish.
Okay.
And next week we'll start looking at the financial statements, which are a little bit different than what we're used to seeing. Okay, well, have a good
Night.
Good night.
Thank you. Bye bye.
Good night.
Good night.